and foremost, ULIPs is a combination of insurance plus market related investments. A ULIPs agent might come to you and say that, you know what, why are you wasting your money in terms of paying premium for your insurance? Why don't you invest that money in ULIPs? You will get some insurance benefit also. Plus, we will invest that money on your behalf in equity or debt instruments and you will keep on getting some returns. Now, this looks very enticing for people because they see that, you know what, insurance pay, why should we waste money? We will just go and rather use that money for investment. And this is one of the worst investment mistake you can make. Now, why am I saying it? Here is a snippet to prove it. This comes from Economic Times and this captures one of the commentaries of a person who purchased ULIPs. So he ended up saying that I purchased my first policy in the year 2000 and he was 29 years old and added 4 more plans as his income grew in the following years. He used to pour in 1.5 lakh rupees in terms of the premiums that he was paying for this ULIPs plan. And he saw a lot of investment option pass by because majority of his money was being tied into ULIPs. Now, why am I speaking negatively about ULIPs? So I would encourage you to go on Google and type out why you should not be purchasing ULIPs. But let me summarize 2 points by this flowchart. So the first key problem with ULIPs is that people do not understand what they are buying. For example, they believe that they are buying some kind of insurance because ULIPs has an insurance component to it. But they do not understand what type of insurance they are getting into. Insurance buying in itself is a very complicated game, and that is one of the prime reasons why ULIP is criticized, because they sell a type of insurance which might or might not suit your needs. So this is the first key problem with ULIPs. Now here your money can go into equity, which means stocks, right? For example, if you're buying Bajaj Finance, HDFC, all these are what? These are stocks. Debt means bond market. For example, if you are buying the corporate debt of HDFC or corporate debt of ITC, that is the debt part of it. Now you don't know as an investor where your money is going, and it has been proven through extensive market research that ULIPs end up giving really poor return on this side of the equation. Now, third and final problem that I have with ULIPs plan is fairly simple, that you do not understand how much commissions you are exactly paying. For example, take a look at this chart. This is based on 50,000 rupee premium that a person is paying. And here are the computations that are done. Now, after all this research came out, a single figure stood out that a person was paying approximately 7% as intermediary charges on ULIPs. So these are very, very high commissions. Just to tell you about the context, that if you are investing in mutual funds, even the worst of the worst mutual funds, you would not end up paying more than 3% commissions. So these are some of the stated problems with ULIPs. Why have I stressed so much about it? Very simple, because a research was done and it was proven that approximately 66% of Indians would love to buy ULIPs. Now this is something which is deeply worrying because ULIPs are probably the worst option in which you can invest your money. Now comes the second option, which is the PPF. Now what is exactly meant by PPF? How much return you can expect, etc., etc. Let us have a very quick conversation there. Now PPF is nothing but an account that is managed by the government. Now your employer or you keep on putting money month after month into this PPF amount, and the government takes that money and goes and invests it in the market. What are they doing at the back end? Let me quickly explain that. So here is a very quick chart. You can see that the current rate of interest offered on PPF account is roughly 7.1. Now this keeps on going between 7 and 8%. So this is a flexible figure, but let's assume 8%. Now the benefit is that this return is guaranteed, that the government says that whatever money you have stuck into your PPF account, the maturity period is 15 years and the government is going to pay you an 8% rate on that PPF amount. You can do very little investments and you will be able to claim tax benefits up to 1.5 lakhs. So what is the advantage? The advantage is that you get guaranteed return of 8%. What is the disadvantage? The major disadvantage is that your lock-in period is roughly 15 years and you're only getting paid 8% returns, which is a really, really bad return over a 15-year timeline. So comes the natural response that, okay, why is it that the returns are guaranteed? And second is that why am I getting so low returns? The reason is that at the back end, PPF investment is done into debt instruments. Debt means bonds. So the bonds are purchased and the returns are therefore risk-free. But the primary issue here remains that if you're locking your money for a 15-year time period, then go and lock it in Nifty 50. Again, the returns are almost guaranteed. They are volatile returns, but over the last 20-year period, the average returns has been 12.5%. And it is highly, highly, highly improbable that Nifty will start giving like 8%, 9% return from 12.5% return. In fact, these returns due to excess money printing is going to improve with time. If you want, I'll make a separate video on that. But if you have to choose between PPF and other market instruments, for example, mutual funds or index funds, then my advice would be that you should go with mutual funds or index fund route. That is much better from an overall return on risk perspective. Now you might have a natural question that Akshat, then why is it that people invest such crazy amount of money in PPF? Well, a few years ago, there used to be more tax benefits associated with PPF. For example, whatever capital gains you were making on your PPF account, on that you didn't have to pay taxes. Now the rules have changed and they are treated exactly like ELSS funds. So what are ELSS? Let me quickly explain that. And let me also prove with data as to why ELSS is much better compared to PPF. Now, if you take a look at the mutual fund universe, then there are 1,000 different types of mutual funds, right? For example, if you take a look at index fund, now what is index? In index, you will have Nifty 50, you will have index Nifty Next 50, you will have Dunia Bhar ke index funds also. So those are a type of mutual funds. Then comes ELSS. So these are tax saving instruments. Here, the condition is that you have to lock in your money for a 3-year period. This is the first key point. Second, your money gets invested where? It gets invested in stocks. Because the full form of ELSS is Equity Linked Savings Scheme. So what is the meaning of equity? Equity means something like HDFC Bank's stock, something like HUL's stock. So what is stock? Stock is basically equity. Equity and stocks are interchangeable words. And here your money is getting invested for 3 years and it is getting invested in stocks. So with that said, let me now show you 2 data points to prove why ELSS is a much better scheme compared to PPFs. Now again, there are 100 different types of ELSS, but if you consider the performance or overall performance of ELSS, you will see that during this phase, or this must be like around 2015 to almost 2020, 100% of ELSS were outperforming PPFs. Then in 2020, market crashed. The market of course crashed. Then also almost 75% of ELSS were outperforming PPF. And this number went up. And now again, almost 100% of ELSS are outperforming PPFs. So now comes the natural question that, okay, fine. Yes, ELSS are performing better than PPF, but by how much are they performing better? Okay, so for this, take a look at this chart. And this difference or this consistent difference indicates the range of outperformance. And this usually would come out to be between 5 to 7%. So this is the number that you need to be aware of. Now, again, in summary, in terms of PPF and ELSS, the tax benefits are the same.